Eli Lilly is one of the best positioned companies in the stock market right now. It is not reliant on a strong economy, just on people trying to lose fat. There may be some other more exciting technologies out in the world right now, but all that matters is your company growing revenue and is it growing profit margins? And Eli Lilly is strongly ticking both of those boxes. That's why right now, Eli Lilly is one of my largest positions. It's a pharmaceutical giant that's growing revenue at nearly 40% year over year. Healthcare companies are always seen as an attractive investment. Kind of like people marrying doctors and dentists, they're attractive because even though they're boring, they offer stability and safety. In recessions or weak economic times, portfolios can drop 50-60%, and it's really healthcare and other safe sectors that can add some layers of protection. Just look at 2022. Not that long ago, we went through an inflation wave that really caused an affordability crisis and hurt many discretionary and tech companies. Meta at the time was down 70% from late 2021 to the middle of 2022. Meanwhile, over that same time, Eli Lilly did have some volatility. However, it managed to return investors 40% over that same 12 months. The biggest reason behind Eli Lilly's recent success, and the reason why it also has a strong future, is all due to a drug called tirzepatide. This compound is sold as an injectable through two key names, Mounjaro and Zepbound. If you have ever heard of Ozempic, well, these compounds do the exact same job in the body, help you lose weight, but there's one key difference. Eli Lilly's drugs actually work better. Now, I'll be upfront here and say I do have a science degree, but the only reason I use it these days is to help make sense of medical articles. The explanation I'll offer here is that these drugs are what I would call hormone mimickers, or they really act to communicate signals in the body that aren't truly there. For example, after you've done eating a meal or halfway through, your body starts to produce a satiety hormone that signals for you to stop eating, otherwise you'll feel sick and eat too much. These drugs in Ozempic and Mounjaro, they do the same job as that satiety hormone, except you haven't eaten anything. Eli Lilly's version of Ozempic, again Mounjaro, the reason why that performs better in clinical trials is it can mimic two different hormones at the same time. It binds to two different receptors, whereas Ozempic only binds to one of those two. I'm not sure whether people are consciously choosing Mounjaro over Ozempic, or maybe their doctor is just saying, look, this one's better, just take that instead. Without being in those medical rooms, what we can say for certain is that Mounjaro is just earlier in its sales S-curve growth. The S-curve growth comes from a maybe slow initial growth. However, through word of mouth and just better advertising, people know the product and trust it. You go through exponential growth until you hit a theoretical maximum in the population. Well, Mounjaro's sales growth is very early in the S-curve. It might be in the peak of the exponential growth, but we've got a long way to go. Whereas Ozempic is 5 years earlier in this process. Ozempic came out in 2017, whereas Mounjaro didn't come out until 2022. As an investor, I would rather buy the company whose major product is still growing in an exponential way, not the one that is starting to slow down. And without diving too deep into Ozempic's parent company, Novo Nordisk, just looking at these two drugs alone, it could explain why Novo Nordisk has struggled over the past 2 years. They're down 28% in stock price, whereas Eli Lilly is up 62%. Now we can dive deeper into the financials of Eli Lilly in just a little bit of detail. We've got this simplified income statement here, and all they show us are their top 3 selling drugs and their revenue, and then the total revenue. So 2 of them are actually the exact same product, or pretty much. We have the Mounjaro and the Zepbound, which are both used to fix obesity. They are both growing year over year revenue at 68% and 172% respectively, the weight loss drugs make up 55.1% of all the revenue. Eli Lilly's third highlighted drug, Verzenio, that is a breast cancer treatment, is growing at 12% year-over-year revenue. And then I've got this other category, which is made up by dozens of other pharmaceuticals. However, each of those drugs is just smaller in their sales. They make up 35.3%. Eli Lilly, just like its customers, are highly reliant on this one weight loss drug. If that entire industry were to collapse, then Eli Lilly as a company would be down in stock price 50, 60, 70% easy. But here's why I'm still making Eli Lilly a confident and large part of my portfolio. The first reason is the customer base of Eli Lilly isn't really going anywhere. They've focused mainly on cancer and Alzheimer's as well as obesity drugs, and the countries with more obesity, they have more money to spend. So to me, that means there's an almost unlimited customer base for Eli's products. The second reason is due to the life cycle of these pharmaceuticals. Now, what happens is you might have a slow growth initially, but pretty quickly you go up to exponential growth. There's a lot of need for these products. However, what tends to happen is the patent for those pharmaceuticals expires. Now, a patent just protects the company and makes sure that other pharmaceutical companies can't just copy and produce your drug. You're protected by law. It's when that patent expires, other people jump on board, they crash the price of that pharmaceutical, and the profit margin and the revenue for Eli Lilly will fall off a cliff. But what's really interesting here is the timing of these patents. Because it's taken Eli Lilly only about a year or two to fully get into the swing of things and sell these drugs, they've got a lot of time left. Zepbound's patent runs out in the late 2030s. Mounjaro's runs out around 2039 because they had some supporting patents. And considering the revenue growth is still firmly in the exponential phase, growing over 110% year-over-year revenue growth, very impressive. I reckon we have at least a couple years left before that starts to taper out. The time to really exit these investments, in my opinion, is when the revenue growth goes from exponential and starts to taper off and slow down, and a mixture of an extremely high company valuation. That's the red flag to me to exit, and I'm just not really seeing either of those two warnings just yet. Now, looking a little bit deeper into Eli Lilly's income statement, just doing a very, very broad overview, the one thing I like to look at for these high growth companies is to make sure that revenue growth of 38% for the entire company is far outpacing the growth in dollars, I guess, of the cost of the business. So the cost only grew around $1.2 billion, so that would be gross expenses as well as operating expenses. However, the revenue jumped about $4 billion, far outpacing the cost, and that's why we've seen earnings per share grow something like 91% this year. And all I see on the radar coming up is very strong revenue growth, maybe even better numbers next year. Altogether, I'm expecting profit growth of 60% next year, probably 40% the year after that, and then who knows. Eli Lilly as a company is very attractive right now, and that's not even considering the giant pipeline of new drugs that are getting investigated at this very moment. We could have the next big $10 billion a year revenue maker coming out in the next year until we pass all 4 key stages of medical research of these pharmaceuticals passed by the FDA and currently in sale. I just value all of those projects as a fat zero. But even though I do that, there is a small chance that we could see this company become even more successful because of these pipeline projects. It's because we've had such strong earnings per share growth in 2025 with an expected 75% growth this year. When we combine that with the roughly 20% drop in the stock price, we just get these really attractive valuations. Now, going back the last 18 months, we've seen some decent buying opportunities when you get around a 30 forward P ratio, but because the growth for the next 12 months is slowing down compared to 2025, now it looks like an attractive valuation is in the mid-20s. I still think the valuation on this company could easily stretch back up 20-30% until we're considered overvalued because profit projections projections over the next couple of years just keep getting raised. If the stock price stays where it is, the company's just getting more and more attractive, and there's just this huge built up upward pressure in the stock price. All it really takes is a good couple months, and Eli Lilly could be up 30%. If you like this video, you're probably going to like these two others that are on the screen now. See you guys next time. Bye.